It's true that is an effective diversifier.
I think this highlights gold can be a great short-term speculative asset, but if you get caught at the wrong time.
It's ironic, only recently my wife and I were talking about what if there was a major global catastrophe.
Welcome to What's the Risk, hosted by myself, Daniel Crowe, and Peter Mansell, founder of Mansell Financial Group, a financial advice business he founded in 1980. This is a simple video series we hope investors can use to better understand index and portfolio performance, along with addressing some investment questions and dilemmas. This episode is on gold, something you can invest in physically, which we've seen lately with people queuing on the streets in Sydney to buy, or you can also buy ETFs now. Now, we don't have gold in our own portfolios, but our clients do ask us about gold from time to time. Usually those times are when it's in the news after strong performance like recently, but we don't tend to hear many questions when it's flat and not in the media, which lends itself to the theory that many investment decisions are behavioural. Your Investment Philosophy, book we wrote, available at Amazon. Disclaimer, please pause and read. Suffice to say, our intent is educational and not rendering financial advice. Don't make a step to sign. These are simple concepts we'd like investors to better understand risk so they can make informed decisions. Periodic performance, and this is in USD up the top, and we're using the S&P 500 as a measure. So it ends in November 2025, and the short-term figures are significantly influenced by that one-year figure, even the three-year figure, but you can't really discount them because they happened and they are returns in the pockets of gold owners. But over the long term, a different picture emerges. The returns are good, but not amazing, and this does include that big run in the 1970s. And the key return here might be the 15-year figure because it seems to illustrate what gold can do, which is perform very strongly over short periods and then drift. And that 15 years captures a drift period post-2012 when it had a really strong performance for about 6 years during the GFC period, and then gold fell out of favour until COVID struck, Peter.
Yeah, look, I think that top row of figures, where it talks about gold and the US dollar price, it's particularly insightful. Like the 1-year number, who would like that? That would be a wonderful experience. But when you look at, say, the 10-year figure and the 15-year number, sorry, the 5, the 10 and the 15, there's some pretty powerful stories in there. The 5-year number, of course, includes the last 1 year, which is 59.5% return. What that means is that the previous 4 years, the return on gold was less than 7% per annum. If you look at the 10-year number, it averages out that, the 9 years before the last 12 months, suggest a return of something around 10% per annum. But the 15-year one, as you rightly point out, is particularly insightful because that shows that if you take out that last year, the average return through the whole 15 years is something like about 3 to 4% per annum. Gold really did just drift, doing nothing. Yet in the 5 years between 15 and 20 going back, the average goes up by 11.5 or by 4.5%. So, the average return much stronger. And then you look right through going back to 1970, we've got 55 years worth of data. Inflation certainly over that period's probably averaged something in the order of 6%. So you can say, yes, gold's been a reasonable hedge, but nowhere near as good as investing in the 500 stocks that make up the S&P index. So yeah, hedge against inflation, one of the criteria that it's often referred to as. Yes, that's come true, but has it delivered for investors a strong return? The answer clearly is not really.
And growth of wealth, again, using the S&P 500 as a measure, and you can see gold was well ahead from the 70s, and despite going on 25 years, 26 years of struggle, it still kept ahead of the S&P 500 until the mid-90s. In more recent times, they briefly touched at the end of the S&P 500's last decade, and then gold's run up during the GFC, but from there, the S&P powered away again.
Absolutely. You look at the difference in the returns, it's about 2.5% per annum over a very long period of time. But the investor who chose to invest in stocks, as a young person, now, they're sitting there a bit older than me, and they've got triple the value of the gold bug
And rolling annual return, range of returns. I think this highlights gold can be a great short-term speculative asset, but if you get caught at the wrong time, you might be underwater for a long time. And it's not often you see something with a negative 20-year return like that.
Absolutely. We've looked at multiple stock index range of returns charts, as we've produced this series over the last 18 months or so. And the first thing that becomes apparent is the range of 1 year results is in excess of 217%. Now that's wildly wider than any stock index that we've looked at over that time. But when you look at the 10 and the 20-year numbers, which starts to be the sort of time horizons that most investors ought to at least think about as a minimum, those pink numbers, in 1980 are pretty damn ugly. That's a lot of pain for a long time for the investor who chose to invest in gold at what proved to be the wrong time. Yes, there are some high 5, 10-year numbers. The 20-year number, nothing special really, but some of those 5, 10 and 20-year numbers are pretty ugly.
And rolling annual returns. And just to highlight the really good and bad with the rolling annual returns, gold will knock it out of the park in short time periods, but also see extended periods of misery. And we'll just drop in there the S&P 500 so you can see it can perform differently to large cap stocks. And just to highlight, the correlation between the two is 0.011, which is probably as close to zero as you'll find with two asset classes, Peter.
And look, it's true that is an effective diversifier. There's no question. You look at the blue lines, you look at the yellow lines, where they're similar and where they're different, and there's an awful lot of variance there. And traditional investment theory says if you've got two assets that produce the same average return but at different times, then blending them gives you a more efficient portfolio. And you might try to draw that conclusion from this particular chart, but it's essential to remember that the average return from stocks over that whole 55-year period have been 2% and a bit below the stock market. So yes, it's been a diversifier, but it hasn't been a diversifier that's added value.
And historic chance of positive or negative, and something to highlight the volatility. I mean, in every thing that we've looked at, we haven't seen an equity index this close to 50-50 over 1 month periods, and 10 years we've never seen something with that high of a historic profile of negative returns either.
No, not at all. This is dramatically against the case for gold, whether you're a short-term trader or a long-term holder. This chart shows quite clearly you've got a much greater chance of getting a poor outcome investing in gold than you would have investing in stocks in basically any index that we've looked at over the last 18 months.
And largest fall in time to recovery, which tells the real story here. If you were convinced to jump into gold after the huge run up in the late 70s and the start of the 80s, and I would assume there was a lot of hype back then about gold, you didn't break even for over 26 years, and that doesn't include inflation. I suppose you started in the industry around that time, Peter. What do you remember about gold back then and the talk about it?
Sure did. I was just looking at the start of the y-axis there on the chart. I'd been in business for all of 7 months at the 30th of September 1980, and I can remember there was a huge euphoria around gold stocks in the first few months of 1980, and indeed gold mining companies. And then we quickly saw gold lose fashion through to the end of 1981. So I'd only been in business less than 2 years. And then gold, if you put a line of best fit right through there, it doesn't improve from the end of 1981 to the year 2004. That's a very long time to be sitting on a bad choice. And 24 years worth of inflation, noting that the 80s was a time of very high inflation, the value of $1,000 worth of gold purchased less than a third of what it could buy in 1981 by the time you got to 2004. Sure, it had a heck of a run between 2004 and 2006. That's in the lead up to the global financial crisis. But 24 years of zero returns, even before inflation, pretty tough pill to swallow.
And risk return efficient frontier. So it's out there where small or micro cap indices have been when we've shown prior, or Australian listed property. So it's incredibly volatile. And for Australian investors, you also have to consider the currency, but it's way out there.
Yeah, if you think about the psychology that most investors would love to pursue, the notion of higher returns with lower risk, you'd say that gold's the antithesis of that, because it's been lower returns with higher risk.
I'd probably ask Peter, obviously we don't put gold in client portfolios, but as we said in our book, it's a speculative asset. And if you want to speculate, keep things in perspective. And it's only really ruinous if you let it become ruinous. Now, if you want to hold it as a curiosity, or I always sort of refer to Peter Schiff, who is a noted gold pumper, I guess you'd say, but he never stops talking about the importance of gold. But even he limits it to 10% of his portfolio, which is size in your portfolio where it's not going to cause you major problems.
Look, I think that's a valid point. If you genuinely believe that gold will somehow retain its value in the event of a major global crisis, it might be that an investor is sufficiently wealthy enough that they can put, say, 10% of their wealth into gold for just that particular possible outcome. Okay. Now, it's ironic. Only recently, my wife and I were talking about, what if there was a major global catastrophe, where the financial system somehow was ruined. We actually spoke about buying farmland as a potential diversifier, because we might be able to produce our own food. That's another extreme view, most unlikely to ever be necessary, but it's another approach one might take to trying to protect oneself from a catastrophic, global financial system meltdown. I must admit that I don't hold to pursuing either of those strategies at the moment, but I can understand why an investor, if they've got the spare capital that they can afford to earn very little from, as their insurance policy for the catastrophe, I say good luck to them.
It does come with a holding cost if you're holding it physically, unless it's stored in your backyard.
And then you better have an insurance company that's happy to insure you against having something of such value that might be stolen.
Yeah, the other point there that I was probably going to point out, that it's for those investors that for the 10% rule, because you see investors sometimes when something like this shoots up in value, they try and move everything from their portfolio, think, oh, I'll jump into this, and then I'll jump into this, and I'll jump into this. The main thing about it is if you keep something consistent, that's where you're probably going to see the benefit from, instead of chasing things with all your money darting around all the time.
Look, it's only a couple of months ago that I was reading headlines, Bitcoin hitting its record value. Headline yesterday, Bitcoin plummeting.
Yeah.
With the greatest of respect to investors that think they can pick these trends and make the right selections, I wish them all the best of luck with the price of gold. We might be looking at an all-time high with gold just recently that might fall away. It might keep going up. Nobody knows.
And sources and descriptions of data. Thanks for your time.